happens when you're looking at just one single stock. You're trying to figure out what return should the market demand from this specific company. You need a price tag for its risk.
And that is our mission today. We are shifting from the big picture of portfolios to the micro level of pricing an individual asset. This is where the capital asset pricing model, or CAPM, comes in. It's a game changer.
Okay, let's get right into it, because this first step is probably the biggest conceptual hurdle. Last time we talked about the capital market line, the CML. That was for efficient portfolios, and the risk measure was total risk or standard deviation.
Correct. Total risk, standard deviation, that was the metric. But the second we zoom in on a single asset, a single stock, we essentially throw standard deviation away. It's no longer the relevant measure of risk.
Hold on, why? I mean, standard deviation is the perfect measure of a stock's volatility, right? How much it bounces around. Why does that suddenly become useless?
Because a rational investor who holds a widely diversified portfolio isn't worried about the unique, company-specific bounces of one stock. That gets diversified away. They only care about the risk that one stock adds to their entire portfolio.
The risk that you can't get rid of.
The risk you can't get rid of, the systematic risk. And CAPM gives us the metric for that, which is beta. So we're moving from total risk to systematic risk. From standard deviation to beta. That's the whole shift.
Right, beta. It's the absolute heart of the CAPM.
Yeah.
Before we get into the rigorous math, what's the intuition? What is beta actually measuring?
Well, think of the market as a tide. And all the stocks are boats floating on that tide. Standard deviation measures how much an individual boat rocks and sways on its own. Beta measures how much that boat rises and falls with the tide. We only care about its sensitivity to the tide itself.
So it's a measure of relative sensitivity. How much does my one stock move when the whole market moves?
Exactly. And to get that, we need to define it mathematically.
Okay, so let's get the academic definition on the table. Give us the formula.
The beta for any asset I, which we write as a Greek letter beta with a subscript I, is defined as the covariance of that asset's return, re, with the market's return, R.
Okay, so how they move together.
And you divide that whole thing by the variance of the market's return, R. So it's cov-re, RR, divided by VAR.
Covariance divided by the market's variance. Let's unpack that for a second. Why that specific ratio?
Well, the covariance in the numerator, that captures the shared movement. The variance in the denominator is basically the market's own, baseline level of shakiness. So by dividing, we're standardizing it.
We're asking, how much does this stock move with the market relative to how much the market normally moves on its own?
You've got it. That's the perfect way to put it. And the most important thing to remember here, the takeaway for any exam, is that for CAPM, the risk of an individual stock is not its standard deviation. It's beta.
So now that we have this new risk metric, beta, we need a way to visualize it. How does more beta lead to a higher expected return? This is where the security market line, the SML, comes in. And let's be very clear, this is not the CML.
No, not at all. A very common point of confusion. The SML is the graphical picture of the CAPM itself. It plots the required return for any asset, not just the efficient ones.
Okay, so if we're drawing this on a whiteboard, what are our axes?
It's a plot of expected return versus beta. So the horizontal x-axis is beta. That's our risk. And the vertical y-axis is the expected return, ER.
Notice standard deviation is just gone. It's completely replaced on the risk axis.
Completely gone. And because CAPM is a linear model, the SML is just a straight line.
And any straight line is defined by 2 points. So where does this line start? What are its key anchor points?
Great question. The 2 points are absolutely critical. First, let's think about an asset with zero systematic risk, a beta of 0.
So it's totally uncorrelated with the economy.
Exactly. What return should that asset give you? Well, it should only compensate you for the time value of money. So when beta is 0, the expected return on the y-axis is simply the risk-free rate, or RFF.
Right, that's our intercept.
That's the baseline, okay? And the second anchor point.
The market portfolio itself. By definition, the market moves perfectly with the market. So what's its beta?
It has to be 1.
It has to be 1. So our second point is, when beta is 1, the expected return must be the expected market return, or ERM. The SML is the line that connects those 2 dots.
So that line connecting the risk-free rate at beta 0 to the market return at beta 1, that represents the CAPM equation. It's the tool we use for the actual pricing.
It is. The equation for that line is the model. The expected return for our asset I is calculated as ERI equals the risk-free rate, RF.
Plus the asset's beta, so beta I, multiplied by the quantity of the expected market return, ERM, minus the risk-free rate, RF.
Okay, that structure feels familiar. Risk-free plus a premium. But let's break down each component's economic job here. Let's start with RF.
RF, the risk-free rate. That's your compensation just for waiting, for delaying consumption. Think of it as the return on a short-term government bond. It's your baseline reward.
Got it. Now that term in the parentheses, ERM minus RF.
That is the market risk premium. It's the extra return investors demand, on average, just for taking on an average amount of market risk. It's the price of admission to the stock market. Historically, it's been, somewhere around 4 to 8%.
So that's the compensation for bearing average risk.
Yes. And finally, you have beta I, the systematic risk coefficient. This is the multiplier. It takes that average market premium and scales it up or down for your specific asset. If the market premium is, say, 7%, but your asset has a beta of 2, you demand double that. You demand a 14% premium.
Ah, okay. So beta is the lever that customizes the market-wide premium to the specific asset's riskiness. It separates the reward for waiting from the reward for bearing market risk.
Precisely. And once you understand an asset's beta, you immediately understand its personality. We can basically group them into 3 categories.
Okay, let's start with the middle ground, the one that's just like the market.
That's if beta equals 1. The asset is expected to move in lockstep with the market index. This is common for very large, diversified companies or big banks that really just reflect the health of the overall economy.
What about the exciting ones, the high-risk, high-reward stocks?
Those are your aggressive assets. Their beta is greater than 1. Think of high-growth tech companies, airlines, luxury brands. Their fortunes are really tied to a strong economy.
And there's that amplification effect we need to remember.
Absolutely. If the market index goes up by 10%, a stock with a beta of 1.5 is expected to go up by 15%. But, and this is crucial, if the market falls by 10%, that same stock is expected to fall by 15%. It magnifies moves in both directions.
Which is why you demand a higher return. Oh, see, so that leaves the last category for someone who wants stability.
Exactly. Those are defensive assets with a beta less than 1. Think of utility companies or sellers of consumer staples like toothpaste and canned soup. People buy those things even in a recession.
The reliable station wagons of the market.
A perfect analogy, if the market crashes 20%, a defensive stock might only fall 5 or 10%. They provide a cushion, and for that safety, investors are willing to accept a lower expected return.
All right, time to put this into practice. The theory is great, but we need to run the numbers. Let's do the mandatory calculation for a hypothetical asset X.
Okay, here's the data we'll use. The expected market return, ERM, is 12%. The risk-free rate, RF, is 5%. And the beta of our asset X, beta sub X, is 1.6.
Okay, a beta of 1.6. Right away, we know this is an aggressive stock. Its required return should be well above the market's 12%. So let's plug those numbers into the formula.
All right, step by step. The equation is ERX equals Bureau 0.05 plus 1.6 times the quantity of 0.12 minus 0.05.
First step, the parentheses, the market risk premium.
Correct. 0.12 minus 0.05 gives us 0.07. So the market risk premium is 7%. That's the reward for taking on an average unit of risk.
But our asset has 1.6 units of risk. So now we scale that premium.
We multiply the premium by the beta. So 1.6 times that 0.07. And that gives us 0.112 or 11.2%. That's the specific risk premium for asset X.
And the final step, just add back the baseline compensation for time.
Add back the risk-free rate. 0.05 plus our 0.112 gives us a final answer of 0.162. So the required expected return on asset X is 16.2%.
And that makes perfect sense. It's significantly higher than the market's 12%, which is exactly what you'd expect for a high beta stock. The formula works.
It does. But beyond the calculation, the economic idea here is really powerful. The core principle is that the CAPM prices assets based only on their systematic risk, which is measured by beta.
That's it. You only get compensated for bearing beta risk.
Which brings up the big question, why does the model just completely ignore all that other risk? The company-specific stuff like a CEO resigning or a factory burning down. Why don't you get paid for taking on that risk?
Right. If I put all my money in one stock and its main product is recalled, I'm wiped out. That feels like a huge risk. Why doesn't the market reward me for it?
Because the market assumes you're rational. And a rational investor wouldn't take on that risk in the first place. You can eliminate it essentially for free just by holding a well-diversified portfolio.
You're not compensated for making a poor risk management choice.
You're not compensated for a risk you could have easily avoided. The market doesn't pay you for failing to diversify. The only risk that's left, the only one that even a perfectly diversified investor has to face, is that systematic market risk. And that is the only risk you get paid to take. The CAPM links expected return to systematic risk through beta.
And there it is. The thesis for today's deep dive. We've bridged the gap from portfolios to single stocks, all by making that crucial shift from total risk to systematic risk. The beauty of this model is its simplicity. It gives you a rational, structured way to figure out the required return for almost any investment. And as you think more about this, here's a final provocative thought for you. If the theory is so clear that the market only rewards systematic risk, and diversification through things like index funds is easier and cheaper than ever, why do so many individual investors still pour their money into just a handful of single stocks, knowingly taking on all that uncompensated, unsystematic risk? What's driving that decision? That's something to chew on. Thanks for diving deep with us.